Good morning and welcome to The Street on BNN Bloomberg. I'm Roger Peterson. Thank you very much for joining us. Coming up on the show today, Rebecca Telcher, Portfolio Manager at New Haven Asset Management, is our guest co-host. Our featured guest today is a finance professor at the Ivy Business School at Western University. He's here to break down the January effect and does it exist still in the markets and what can we expect for this month? That's in 30 minutes. And of course, we want to hear from you on First Call. You can reach out with your questions on Canadian dividend stocks, and we'll have Rebecca answer as many of them as she can. The number to call, 1-855-326-6266. We will open the phone lines in about 30 minutes. And our email address, if you're a little bit shy, first call at bellmedia.ca. Now, some of the stories we're tracking for you in the BNN Bloomberg newsroom. Lundin Gold says it has found a potentially world-class copper deposit in southeast Ecuador. The CEO of Lundin telling reporters the area the deposit was found in has the ability to rival other copper hotspots, including Peru and Chile. The company is now figuring out next steps and says that development will require extra studies. The price of nickel is falling after hitting a 19-month high early this year. The fall comes after Indonesia did not provide information about their planned output cuts. Indonesia previously reported they plan to reduce production this year in an attempt to improve balance between supply and demand. Indonesia's Energy and Mineral Resources Minister claims that the figures are still being finalized. And now our top line story. Prime Minister Mark Carney's upcoming trip to China marks the first visit by a Canadian Prime Minister since 2017. CTV's Annie Bergeron-Oliver has more.
After years of tense relations, a change appears to be brewing as Prime Minister Mark Carney gets set to try and address thorny trade issues in Beijing with Chinese President Xi Jinping.
No doubt there are going to be challenges and that, the two countries won't see eye to eye on everything, but there are some common and shared interests.
Next week's visit will be the first by a Canadian Prime Minister in nearly a decade, and the first since China arrested and eventually released Canadians Michael Kovrig and Michael Spavor in retaliation for Canada's detention of Huawei's Meng Wanzhou.
I really wonder if we'll get anything more than promises out of the People's Republic of China.
One of the biggest flashpoints that's expected to come up, tariffs. Canada imposed a 100% tariff on Chinese electric vehicles in 2024, a move met by China, who implemented a punishing 100% tariff on canola oil and a 25% tariff on certain pork, fish, and seafood products.
We hope that there'd be tariffs, removed immediately. But as I say, this, history has said that the removal of those tariffs does take some time.
But while this three-day trip is being viewed as a relationship reset, experts say Canada has to be cautious not to trigger any alarm bells in Washington, with negotiations on the North American trade deal set to begin later this year.
If we are seen to go too far down the path of befriending China, we know who in Washington is going to be irritated by that.
But while trade is expected to loom large, the Prime Minister's office says energy, agriculture, and international security will also be up for discussion.
That was CTV's Annie Bergeron-Oliver. Let's bring in our guest co-host, Rebecca Telcher, Portfolio Manager at New Haven Asset Management. Rebecca, always a pleasure. Happy New Year to you.
Happy New Year.
We have one more day of saying that, and then we have to move on. It's end of the year now. This visit to China, what do you think? What can we expect from it, do you think?
Yeah, Carney's in a tough spot. He's going to have to, balance, a good relationship with China, but at the same time, you want to try to maybe not say too much and you want to keep things good in Washington. But, when I think about what's happening in China, they've been, stockpiling a lot of oil. They've been buying tons of oil from, Russia, from Iran, and some from Venezuela as well. What does Canada have? They have lots of oil. And, when Carney's talking about the possibility of building a new pipeline off of, an export pipeline off the West Coast, a lot of that could go to Asia. So, China needs oil, natural gas. Canada has it. So, and for a long time, we've been saying that we're too dependent on just the United States, and we need to diversify our capabilities to export energy, outside of the United States. Mm-hmm. So this could be, an opportunity. But like I said, it's a difficult situation. He has to tread lightly.
Does it feel like this is maybe just to break the ice? It's like he's not going to come out and announce, hey, we've dropped the tariffs on electric vehicles from China. This is just trying to get things going again, because not much has happened really in the last 8 years, and it's been a little vexatious at times. Yeah.
So, you're right. Not much has happened. I mean, with regards to any kind of, business development in the past 10 years in Canada, Carney, same political party, but I think he's trying to be a little bit more business friendly. Absolutely. So, I think he's saying the right things. But I do, as one of the commentators said, that, all of this takes time. I don't know if tariffs are going to be dropped immediately or if this is just going to be the opening of a new dialogue. But I think it's a good first step. And I think we'll see how Washington reacts to that as well.
Do you feel there's enough markets outside of the U.S. that we can find to replace the U.S., or at least a large portion of it?
A large portion of it. So first, I don't.
Or at least somewhat of it, some of it, because it's just so convenient. That's the part of the problem.
Right. It's not only just convenient, but the existing infrastructure pipeline, and we could talk about that a little bit later. It makes it very hard to displace. But
we are going to.
Yeah, exactly. I think about China, and they consume so much electricity to the point where, we're all trying to, lower greenhouse emissions, and we're coming off coal. But, China's still putting in new coal plants, and they're still putting in oil plants. And so, they desperately need different, outlets of electricity. And so I think, in my opinion, that natural gas is going to be a real winner here. We already have LNG Canada that's, exporting natural gas to Asian markets, and we could expand that. But at the end of the day, these are the things that the Asian markets need. So, can we diversify? I think the answer is yes, because there is a demand for it on the other side. Okay,
we're going to talk about more about the oil coming up just after the break. Thank you, as always, for joining us. But we're going to take a look at the markets before the bell as well. Let's see how things are shaping up on the markets. We'll start with U.S. futures, and some profit taking may be continuing right now. You can see they're trending down again today. You can see the Dow off by 0.37, NASDAQ 100 down by about a quarter, and the S&P 500 off by 0.18%. Let's see what the Asian markets did today. Similar situation. The Nikkei has been a bit of a roller coaster up and down. Today it's off by 1.63%. Hang Seng down by 1.17%, and the CSI 300 down by 0.82%. Investors cautious there after that quick start to the new year. Heading over to Europe, down. Defense names outperforming, but big retailers and rate-sensitive areas are dragging things down a little bit. You can see FTSE still above 10,000, but off by 0.3%. CAC 40 down by 0.28%. And the German DAX is about similar, in that range there. And the TSX, that positive run for the new year ended yesterday. Investors taking some profits there as well. It was off by 0.84%, but still above 32,000. Who were the movers? Let's have a look here. Definity Financial up 4.81%. OR Royalties up 4.54%. Brookfield Business going the other way, down 6.57%. Capstone Copper off by 7%. And looking at the metals, they are all in the red as well. Bit of a pullback there. Gold's off by 0.78%, but still up about 5% for the past month. Silver on that roller coaster. It is down by 4%. And copper seeing some short-term momentum cool, but it is still up overall over the last year. And oil, which we'll be talking about in just 1 second. Look at the hit that Western Canadian Select took yesterday, down 3.76%, still struggling there. And WTI, what's it doing right now? A little bit of a bounce back today, up 1.52% to 56.84 a barrel. And oil is what we're going to talk about right now. Our guest host, Rebecca Telcher, is portfolio manager at New Haven Asset Management. And you think Canadian oil, with everything that's unfolding right now, Canadian oil is not going anywhere, at least for now.
Yeah, I mean...
Or it might be going somewhere else, but it's going somewhere.
You know, like I mentioned before the break, the infrastructure, the North American infrastructure is so complex and embedded that it makes actually, you know, displacement is not easy. First, there's so many more questions than answers right now as it relates to Venezuela. And it's interesting to see the market react so sharply when there's still so much unknowns with regards to, so, you know, the market's been up since the beginning of the year. The only sector that's really been hit are Canadian oil stocks. And so, you know, there's clearly this, the market thinks that there's this risk that Venezuelan oil can displace Canadian oil. But if you actually look at the facts and the underlying fundamentals, I mean, I don't think this is a risk in the next few years. There's, you know, so my first question is, you know, what is Trump actually going to take over the oil production too?
He's now saying indefinitely. They're going to run it indefinitely, whatever that means.
Whatever that means. More questions than answers. How is that going to happen? What's going to happen at Congress? But regardless, even if that does happen, you know, the estimates I'm seeing are $50 billion to in the hundreds of billions of dollars of investments over the next 15 years just to get, you know, production back to 3 million barrels a day versus, you know, less than 1 million of what they're producing now. The question also is, do these U.S. producers even want to go in given the heightened geopolitical risk? I mean, you know, the expense,
just the expense alone.
So do they want to be investing capital in a country that they don't know who the leader is right now, and they don't know, you know, if Trump leaves in 3 years, like, are those policies going to continue? I don't know if they want to. I mean, a lot of these U.S. oil companies have their hands full in U.S. shale right now.
What kind of an incentives do you think it would take from the would the American government offer incentives to get those companies back in? Chevron's there already on a reduced rate to get them back into Venezuela, or is there even enough incentives to convince them that it's worth it? They got burned once.
Yeah, exactly. I'm not, you know, I really don't have the answer to that question, but it is a valid point of, you know, if they have the appetite to do it, maybe with the right incentives. But again, even with the right incentives, all those incentives can roll off, you know, as the presidency comes to an end. So, you know, that's the Venezuelan part of the question. And then you look at, you know, Canada and what we produce. And so, you know, our oil pipelines are full right now. You have oil going from, you know, Canada to the Gulf Coast, but you also have oil going from, you know, Canada to, let's just say, the Chicago hub area. Right now, there's the existing pipelines that we have. There's no pipeline to pipe Venezuelan oil from the Gulf Coast to the Chicago area. Like, those pipes are no longer in service. So
they would just be down on the Gulf Coast.
Exactly.
Gulf Coast,
so again, you know, it's really complicated. You know, Canadian oil, you know, I think competes internationally. You know, we talk about oil sands, but, you know, the CapEx is really spent up front. And so the ongoing maintenance CapEx is actually very low given where the Canadian dollar is. You know, I think Canadian oil is very attractive. You know, there is a logical buyer. Canadian companies have been living through, you know, austerity through, you know, government policies for the past decades. They've gotten really efficient over the past 10 years with lower oil prices, and they continue to thrive. So
could this lead to more investment, you think, in Canadian oil?
Well, I do think that this could lead. This brings the case to make a new pipeline, as we talked about previously, that, you know, if Carney is looking at, you know, the reliance on our exports to the U.S., I think this brings a really valid a case for a new export pipeline to Asian markets. If we do think. And again, I don't think this is going to be in 1 year, and I don't think it's even going to be in 3 years. If this happens and there is some kind of displacement of Venezuelan oil, it's going to be, let's just say, 5 to 10 years. Can we build an export pipeline in the next 5 to 10 years to displace whatever, you know, incremental Venezuelan oil the U.S. takes? You know, yes, I think so. So I don't think Canadian oil is at risk as long as Canada plays it smart and we make the right moves. There hasn't really been that much.
That's the problem. Is there the political will on all levels?
Again, you know, we have a new prime minister who seems to be, you know, business friendly. He's saying the right things, and I think, you know, if this Venezuela, momentum of U.S. taking over their oil continues, I think this actually pushes Canada in the right direction to get that pipeline built and fast.
Okay, but we have David Eby in BC who's been pretty vocal about not wanting to see that pipeline, so that'll be a challenge for them.
Again, this comes down to, I'm here talking about what makes sense logically and fundamental. I cannot speak to what makes sense politically. I am done trying to make sense of what I'm done. I can only talk about what the logistics. I can't talk about the politics, unfortunately.
All right, we'll wrap it up there. But Rebecca's coming back, and we'll see why Enbridge is on her radar. That's next. Let's see what's on the radar for Rebecca Telcher, portfolio manager at New Haven Asset Management. There are two energy companies you want to talk about. First up, we'll start with Enbridge. Perfect week to be talking about energy companies.
Yeah, again, this all goes to what's been happening in the markets. The markets continue, we keep seeing all-time highs, record highs, and the only sectors to be really hit are Canadian oil and oil transportation companies. The funny thing is, like we said in the last segment, if there is a displacement to Canadian oil, this is a medium to long-term trend. The funny thing is if I look at, I think there's tons more risks that are near term that are being completely discounted by the market right now. So, the way I look at it is we need to be positioned defensively, geopolitical risks are at an all-time high. The economy is weakening. Now is a good time to be defensive. And okay, if you want to bring all of these energy companies down, I'll just buy some more because the yields are sustainable. So, Enbridge is down 5 to 6% in the past week alone. The dividend yield is 6.2%, and it's continuing to go up because that yield is backed by long-term contracts, take-or-pay contracts, whether that oil is is on the pipes or not. But they are, because those pipes are full.
Yeah.
They have $37 billion of CapEx and growth projects. So, the one project I would say that's at risk is, they made an announcement, in Q4 of last year that they're going to expand the main line. And so, okay, in 5 to 10 years, if Venezuelan oil depletes, maybe they're not going to do that expansion. But that was a $1.4 billion project out of $37 billion. Yeah. It's really minimal for them. Most of their growth projects are actually on the gas distribution side, which is very utility-like. Most of their growth and their acquisitions in the past few years have been on the gas side and on the utility side. So, they, on a relative basis, yes, they still have those oil pipelines, but relative to their overall, it's getting less and less as they invest in gas. And
I think we forget the demand is still growing for oil, right? It's not going away. I think they're talking about the second half of the century being one of the most critical. It'll be one of the largest consumption half century ever.
Absolutely.
Because we still need populations are growing.
I really think it's the fundamentals are not the people who are selling Enbridge and CNQ right now are not the fundamental investors. It's that quick money. It's the hedge funds. It's the quants that are looking for a trade because the fundamentals are still actually very strong. The other stock I wanted to talk about was CNQ. That's down 9% in the past 5 days alone. Dividend yield 5.6%, so really high and still growing. And then again, let's look under the hood for how CNQ produces their oil. Only 15% of their oil is conventional heavy, and that's the oil that would compete with Venezuelan. 40% of their production is actually natural gas, which is underappreciated right now as natural gas prices are really low.
I was looking, gas prices there was a prediction that it could go up about 80%, did I see, for the year?
Yeah, we've had a really
for natural gas.
We've had an abnormally warm winter as well, so natural gas prices are off. But the rest of Canadian natural resources oil production, it's oil sands, but it's actually upgraded. So it's called synthetic crude. So they do additives to the oil that comes out, and then it actually turns out to be light oil that competes, with WTI, or actually it's a better grade than WTI. It's a light oil, so it doesn't compete at all with what would be, Venezuelan production coming on in the next 5 to 10 years. So my opinion, both of these stocks are off. Can we see lower oil prices in the short term? I do think so. We saw that yesterday because Trump is announcing that they are buying Venezuelan oil, but they're not buying new production. They're buying existing stockpiles. So I think as we see those stockpiles or the reserves come down, we could see oil prices be hit on a short-term basis. I think on a long-term basis, these are really good long-term opportunities.
Well, and aren't we running overproduction at about 900,000 barrels a day right now?
Sorry, for
overproduction, there's excess they have right now, isn't it? Like almost 900?
For oil?
Just in general.
Yeah. So, I mean, again, that goes to like OPEC plus that are, that they are overproducing right now. And then again, we are going into a weaker economy. As we go into a weaker economy, the demand for oil, which actually has been pretty strong as of late, but the expectations for oil demand are coming down if we do go into a weaker economic environment. But again, those are normal ebbs and flows of an economic cycle. I do think, over the longer term, these companies will do fine. But companies like CNQ, whether oil, we've gone through this before. We've gone through prolonged weakening prices in 2015 for many years. We went through negative oil prices in 2020. CNQ continued to operate.
They know how to weather these things.
They didn't lay off one employee. They continued to raise their dividend. They didn't speculate. They're in it for the long term. Again, when it comes to oil sands, all that CapEx has already been spent, so the maintenance CapEx is actually very low. So they're going to continue to produce in any kind of environment. I think even if we see prolonged oil price weakness as it relates to, Venezuela's reserves coming down and stockpiles coming down and, weakness from lower demand, I think they'll still continue to thrive as we come out of it.
Okay, we're going to take a break on that note there, but we'll be back with lots of things then. Looking ahead first, the January effect, is it still there? We'll talk about that with our next guest, and our phone lines will be open for our first call segment. You can reach us at 1-855-326-6266. Email us, firstcall@bellmedia.ca. TELUS has hired TD and Jefferies Security as advisors to aid in its review of TELUS Health. The company says the hiring of these advisors will help develop monetization strategies. The CEO of TELUS says that the focus for TELUS Health is finding a strategic partner. Lundin Gold says it has found a potentially world-class copper deposit in southeast Ecuador. The CEO telling reporters the area that it was located has the ability to rival other copper hotspots, including Peru and Chile. The company is now figuring out its next steps and says that development will require extra studies. The price of nickel is falling after hitting a 19-month high early this year. The fall comes after Indonesia did not provide information about its planned output cuts. Indonesia previously reported they plan to reduce production this year in an attempt to improve the balance between supply and demand. Indonesia's Energy and Mineral Resources Minister claimed that the figures are still being finalized. Quick peek at the U.S. futures right now, and it's still looking for a down day, but the Dow off by 0.28 right now. The NASDAQ and the S&P 500 pretty much a wash at this point. Well, just days after ordering the U.S. military into Venezuela to capture the president and his wife, Donald Trump is again blasting NATO. And the White House says the U.S. president is actively discussing how to acquire Greenland with military force on the table. For more on this, we spoke to Peter MacKay, the former Canadian Defense and Foreign Affairs Minister.
How seriously do I think the possibility of the United States attacking Denmark is? Not very. I think, number one, there are much bigger priorities for him, although he has clearly coveted the critical minerals and the strategic advantage of having Greenland. But it's another NATO country. They're part of Denmark. There has been a lot of musing and a lot of bombast and a lot of braggadocious nature within this president. But a military attack is one thing. Trying to work out some sort of an association with them, keeping in mind that they have a military base in Thule, Greenland. They now call it Piftik, I believe. But there is a historic relationship there, concerns about the vulnerability of the Arctic, which Canada shares, the fact that the U.S. has other similar type of relationships with countries where they provide security. That's a more realistic pursuit than any kind of an invasion, in my opinion.
Okay, we often hear Donald Trump sort of go big with the threats only to ratchet it down to come to some sort of agreement, and you're thinking that could be what happens here, some sort of agreement with Denmark and Greenland to get access to what that island offers?
Exactly. And using leverage like this by starting big, as you put it, and then working their way back. But look, the situation in the Arctic is serious. There is concern about Russia. There is concern about China, others navigating in or close to Canadian waters. And so this is something we need to keep an eye on. But, you know, we saw the Prime Minister in Europe telling Denmark, the president there, that, you know, we stand with Denmark and our NATO allies. I think there's plans now to open an embassy there, visits from Canadians. We have to be a little bit careful walking that line, not poking the bear, so to speak. But I really don't think that this is going to be a pursuit, a realistic pursuit by the U.S. administration. And I think people like Marco Rubio are going to try to walk this back at some point in the near future. You
mentioned Arctic security. We know that Canada is trying to beef up the defense of the Arctic as part of its plans to put more money into sort of security itself. So is that threat at this point escalated to a level that perhaps Greenland needs a bigger military presence from the U.S., Canada, or others?
Well, I think I would focus more on what Canada has to do. And we've been in talks now for some time about improving the security around the Arctic. That includes a form of missile defense, although not likely the Golden Dome that the president has envisioned, but certainly finally pulling ahead with the fighter aircraft purchase. We need to recapitalize some of the airfields and infrastructure in the Arctic. Being able to operate this time of year and later into the winter is very difficult. Minus 40, minus 60 in some instances in pitch dark. And those waters are opening because of climate change. And so this has been on the government's radar, successive governments, for some time. But it's a massively expensive undertaking as well, and something we should be doing in concert, frankly, with the Americans, but with other Arctic Council countries. And we are drawing closer to those countries, including Finland and Sweden, who are now NATO allies, and working towards this ice pack realization where we are going to build, in concert with the Americans and the Finns, more icebreaker capability.
Okay, just to pick up on another thing we heard from Donald Trump today, that NATO is nothing and without the U.S., and we've heard the rhetoric before. But I just want your opinion on whether or not NATO could stand without the U.S.
Well, they could and they would. It's obviously not preferable. And I've sat at those NATO tables, to be honest with you, and we've been hearing complaints for some time, rightly so. We were not living up to the agreed upon 2% of GDP spending on national defense. We got close. And during Afghanistan, we were punching above our weight, as Canada has done for decades, but still not really paying our way, paying the freight, so to speak. And that has riled the Americans, successive governments, including Obama, Reagan, Bush, others. But we're getting there now, or so it seems. The commitment has been made. The money has not really been allocated or even identified as yet. So there is still some skepticism about whether we're going to be able to reach that capacity. But look, NATO, it has been and continues to be the most important military alliance in global history. And Canada is a founding member. We need and want the Americans to be part of it. But attacking another NATO country would see its unwinding potentially quite quickly.
Okay, let's also get quickly to another issue, which is a trip by our Prime Minister to China and a meeting with the leader there. What should the Canadian priorities be for Mark Carney?
Well, I think trying to work out some sort of trade arrangement that at least sees the dropping of tariffs. They have tariffs on Canadian canola and seafood and pork. We, in turn, have put tariffs on aluminum and steel and EVs, vehicles. So working out some of that, I suspect any trip, and I've been in some of those meetings with Chinese officials, there may be talk of human rights concerns towards Uyghurs, Tibetans, Falun Gong worshippers. We've seen Canadians kidnapped. We've seen intellectual property being stolen by China. They have an abysmal record when it comes to human rights. And so those items often come up. So those discussions are delicate. But let's be clear, the trade deficits that we have with the United States, or shouldn't say deficits, we do approximately $700 billion annually. It's much, much less with China, although a lot. So there's capacity to grow, but we're never going to supplant or completely replace that trade with the United States. And again, we have to be careful and cognizant of the fact that China and the United States are on a knife's edge as well. And so we don't want to go too far in suggesting that we're going to sell them our surplus energy, which questionably we can't get to them because we don't have the necessary infrastructure. Nor do we, as we saw in the case of recognizing Palestine or coming down too hard on the side of those who are criticizing the United States, the president takes it very personally. So caution has to be part of that trip to China. I suggest we can also do more with other countries in the region that are more closely aligned, that are democratic, like Japan, South Korea, not just talking to the Chinese Communist Party.
Well, I was speaking with Peter MacKay, the former Canadian Defence and Foreign Affairs Minister. Still ahead, we're going to take a look at the January effect in trade with our next guest. And our phone lines are open. Rebecca Telcher is taking your questions on Canadian dividend stock. Call us at 1-855-326-6266. You can also email firstcall@bellmedia.ca. Bit of an off day yesterday, but January starting strong, and it's known to be a strong month for stocks. It's called the January effect, and we're exploring the factors that make this month an ideal time for investors and whether it will be another opportune trend for this year. Here to talk about it is George Athanasakos, the professor of finance at the Ivey Business School at Western University in Ontario. And Professor, thank you very much for joining us.
Well, thank you for having me.
Okay, first question. Is the January effect still an effect? Does it exist still?
It exists. It's an average effect. It doesn't work every year. It works on average. Let me just put this in the context. I'm a value investor. As value investors, we believe that price and value are not the same. And the question is, what makes price different from value? There are two things. One is human nature. Humans are not rational. They have many weaknesses. They herd, they extrapolate, they are over-pessimistic, they panic, they get greedy. But the other one I want to talk about more is professional biases. Professionals, driven by self-interest, they trade throughout the year in a way that affects stock prices throughout the year and make the price deviate from value even within a year. So professionals want to maximize the take-home pay, which is basically salary and bonus. And the bonus can be very big. So in January, they say, because they have one annual remuneration cycle. So in January, they say, what should I do to secure my bonus at Christmas? They know from school that the higher the risk, the higher the return. So in January, they say, let me get out of safe positions and go into riskier positions that is riskier than the benchmark. So the herd in January goes towards riskier stocks, and they drive them up. If you look at the chart of stock returns, the January returns are very strong.
Yeah.
Now, throughout the year, as they realize the Christmas given bonus return, they slowly get out of the riskier positions and go back to safer positions.
So essentially, it's inevitable. Like the market creates this cycle.
So the rebalancing they do, but they're not stupid, right? They don't go blindly in the stock market every year. That's why I say it's an average effect. All depends on how the professionals feel the year is going to unfold. If they believe the year ahead is going to be a bull market, they go heavily into risky stocks. If they think the market next year will be weak, they avoid riskier securities. And so what we observe is when the market is strong, we have a very strong January effect, but on average about 7% a monthly return. When the year is weak, you have a negative January effect. So it all depends, I guess, this year, what the professionals will do. If they are positive about the year, then we're going to have a strong January effect. If not,
we're going to go.
Be a weak effect.
Professor Rebecca wants to jump in and ask a question.
I'm just curious. Do you think central bank policy has changed these effects? Because I feel like the market's been very reliant or have been focusing more on is the central bank going to cut again? And the market's been reacting more on policy than it has been on some of these nuances and effects.
Definitely. And what the government does affects the shape of the yield curve. And my research shows that whenever the yield curve is positively sloped, that is, the short rates are way below the long rates, this is positive for the markets. And we normally observe strong Januaries when the yield curve is positive and when expectations about profits are increasing. So this year, from what I see, we have a slightly positive yield curve and slightly positive expectations about profits. So this is positive for the January effect. But again, these are not very strong indications. Again, it goes back to institutions, to professionals, how they view this. Do they view this as a positive for the markets or negative?
What about, we've seen more and more retail investors coming in. Are they starting to have a similar impact to the institutional investors?
Well, we've seen the last couple of years, what drives the market is primarily retail investors. Most of the professionals seem to stay on the line, on the side. And this is another big risk because retail investors are up to here in margin debt, and they're not very good in market timing. They are the worst market timers. Historically, whenever retail investors go heavily into equities, this is a negative effect, a negative sign. The market's probably reaching at the peak. Because, again, if you look at the evidence, there was a study by BlackRock, and they found that on average, the last 40 years, equities return about 8%, mutual funds. And then they look at the individuals who hold these mutual funds. And the individuals, even though the fund made 8%, the individuals made 2%. Okay. And the question is, how is this possible? Well, it is possible because humans, based on the weakness of human nature, they tend to buy at the peaks and sell at the bottoms. They panic at the bottoms, they're panic-stricken at the bottoms, exuberant at the top. And if you do this, you're never going to have good performance.
All right, we're going to have to wrap it up there, Professor, but thank you very much for joining us this morning.
You're welcome. Bye-bye.
That is Professor George Athanasakos. He's a professor of finance at the Ivey Business School at the University of Western Ontario. Still ahead, we'll take a look at the notable analyst calls and recommendations moving the markets, including Alphabet. Let's take a look at one of the notable analyst calls and recommendations moving the markets today. Alphabet shares are up in pre-market trading as Cantor Fitzgerald upgrades to overweight from neutral. Analyst Deepak Mathivanan says Alphabet has the strongest footprint across several layers in the AI tech stack. Mathivanan also notes that the firm's decade-long investments have enabled deep competitive moats, and with regulatory headwinds easing, we expect Alphabet to reap benefits by leveraging its distribution in consumer and enterprise over the next 3 to 4 years. as AI transitions from the frenzy to the synergy phase. The price target is set to $370 US, implying a 15% increase from last close. When we come back, Rebecca Telcher, portfolio manager at New Haven Asset Management, takes your questions on First Call. Okay, time for First Call, and our first caller is Daniel from Markham. Good morning, Daniel.
Hi, Roger. Hi, Rebecca. Hi. Great host and one of the best guests.
Oh, thank you.
My question is on ARC Resources. Do you see ARC Resources as a leader in natural gas distribution in North America? Thank you for taking my call. And First Call, great show.
Oh, thank you. Absolutely, ARC is one of the top. It is one of the top gas plays in Canada, like that and Tourmaline. I mean, and CNQ. They are the second largest gas producer in Canada, even though it's an oil company. But we like ARC Resources. It's the gas producer that we own. Lots of liquid gas, so a lot of it is used in condensate, so to add to heavy oil. So actually, if you do believe that Venezuelan oil will eventually, displace some Canadian oil, then they're going to need more condensate, which is a lot of what ARC produces. But what we like about ARC Resources is that a lot of their gas production is linked to international prices, with LNG Canada moving natural gas off the coast of BC. We should see, strength. We're seeing new gas power plants being built. So we're positive on natural gas. And stock is really off. We've seen, again, it's been an unseasonably warm winter. Gas prices are plummeting. Again, this is a short-term phenomenon, but like if we can get ARC Resources under $25, we're buyers of it. ARC is one of the strongest management team and has a very strong balance sheet. So we are owners and buyers of it.
Okay, we'll leave it on that. And we'll go to an email from Tony. It says, good morning. Would like Rebecca's take on Northland Power after the outlook and see what the outlook is for 2026. Would it still be a buy? Thanks. Have a great day.
Yeah, I rarely, change my opinion on a stock, but this is one of them where this has actually caused the most stress. Lots of gray hairs caused by Northland Power this year.
I don't see it either.
Because it was one of my top picks for a really long time. And then when they announced earnings, they dropped the bombshell. One, they cut the dividend 40%, which I believe they didn't have to. In my opinion, they should have done some asset dispositions instead, because when you cut a dividend over a short-term problem, that's a long-term commitment you're breaking to shareholders. So that's one thing.
Which raises questions, I imagine.
Exactly. And then, they cut the dividend because there's a delay in Hai Long, which is one of the Taiwan offshore wind projects. And so I also wonder, too, if you're telling me it's only being delayed, the commissioning is being delayed by 1 quarter, why are you cutting for long-term,
what else? What else is there?
Why didn't you could have issued equity, you could have sold assets. But now we're also looking at a new geopolitical landscape. So one of their large project is Taiwan. They also have a lot of assets in Colombia. Both, geopolitical risks remain really high in those two jurisdictions. A lot of the growth that they're looking beyond these offshore wind projects are battery storage. It's more of a new, unknown, technology. So, what I liked about Northland Power, let's just say 5 to 10 years ago, which is when we got invested, is that they were long-term owners and operators. They would construct the project. They were really good at constructing under budget, before, on time or early, and they would own and operate those assets. But now they've kind of shifted because of this Taiwan project. They're announcing that they definitely need to do some asset dispositions. Maybe they're going to look into merchant power because wind prices have come off in some of these contracts. I mean, it's a whole mishmash, a new management team, their third management team in a few years. So I think we've been very disappointed. We haven't exited yet because, I think there was a lot of tax loss selling that happened at the end of last year. We're hoping to see a bit more of a recovery. We're holding on for now. I don't know how much longer, but I think we've definitely lost faith in, maybe not so much, I think this management team is doing the right thing, but I think the last management team really screwed up. But I don't know if I want to wait around to see if this ends up getting fixed.
Okay, we're almost out of time. Let's try and sneak in one more email from Sandeep I would appreciate your insights on whether freehold royalties should be a suitable stock to hold for the long term, particularly in light of the risks and volatility currently facing the oil and gas sector.
Yep. So we own Freehold as well. As you mentioned, it's a royalty company, so they don't have any drilling or exploration costs, which makes it really attractive. They basically own the land. They get paid from the producers by the amount of oil. As long as drilling is being done on the land, they're getting paid. The question is there going to continue to be drilling? They own assets in Canada and the U.S. I think maybe U.S. is a little bit of a question mark over the long term. Over the short term, we're happy to own it. 7.4% dividend yield. So when a company has dividend yield that high, we're not really expecting the market, stock price to bring, that much more to it. We're happy collecting that dividend. It's a stable name. They have cut the dividend in the past, but I think we need to look at sub $50 oil before that dividend is at risk. Their break even is around $50. So we're okay owning it for now. I'm not sure if I'd be adding to it at, prices. It has had a run up recently, but we still own it.
All right, we got to wrap it up there. Rebecca, thank you as always for joining us. Always appreciated. That is it for us here on The Street. Again, thanks to Rebecca Telcher, Portfolio Manager at New Haven Asset Management, for joining us today. And he's up next with the Open, and the markets will open a little over 30 minutes from now.